right, welcome to Your Time, Your Money, the show where your time is just as valuable as your money. So we want to make sure that you get value and education to every podcast that we do. Thank you so much for joining us today.
Thanks so much, everyone. We're excited to have you on another show. Another great week. Mark starts us off right after February break here. We're excited to be here, and I'm happy that we get to chat again. The last couple shows have been great, and I can't wait to get this one going.
Yeah, I'm excited. I'm a little tanner. I don't really tan, but I'm a little tanner than last time. With
you freckle. I'm in this dark all year. I'll beat you. A couple days of sunshine, and I'll be beating you. So I'm excited about that.
Excellent, man. So, glad to have you back. We got some great topics that we're going to be covering, and today we're going to cover, one I think is very special for Capital District area, being that there's a lot of state employees and a lot of people in the pension system, and that's pension option planning today. So pretty excited about it. We're going to make our best effort to walk through a very complicated topic and hopefully shed some light on it in a simple manner that clients can understand.
Yeah, it's something that it's a concept, right? And that's really when I start to do pension option planning, which I feel like over the last 8 years, that's become my specialty on our team, which is it's just focusing on making sure you're maximizing what you're going to get for your situation. And everybody is different. So that's why it's really hard to draw those big, broad strokes. And because everyone's situation is different, right? Are there two pensions? Are there one? What's my health like? What's my longevity, right? So there's a lot of factors, but we'll try to cover all those today and hopefully ask some good questions. And I've gotten some great feedback from people, and we're asking great questions, and they're sending questions in. I can't wait to tackle some of those. Hopefully we get to do a live one soon.
Yeah, and just a reminder to our listeners that if they have questions about any varying topic, please send them in. We'll get you the contact information at the end, but email them in, submit them online or whatever you might. And that way we can actually record sessions based on common questions that clients have. We like nothing more than bring value to what the client wants as well. So
absolutely, man. I agree 100%. We got to get again, once we get this down pat and we get some live viewers, I feel like it's going to get really cool. We're going to get in the weeds, which is great. That's where we want to be.
Yeah, that's great. Well, let's get started. I'll let you do the honors.
All right, man. I'm excited.
All right, it's your time.
It's your money. Let's get it going, man. I'm excited to get this started today.
Great. So let's just start with an understanding of what pension option planning is, right? Yep. So for those listeners that have a pension, when they go to retire, their pension is based off a couple different factors, right? It's based off of their average salary, right? Sometimes it's their average 3 years, sometimes it's their highest average 3 years, but it's their average salary at the end and their years of service, which gives them a percentage of a guaranteed payment for the rest of their lives through either the New York State pension system or, let's say the government pension system or what have you.
Sure.
And that percentage is, a portion of what they're used to live off of. Right. So I think that's important to understand. It's not their whole pay. Right. So, they really want to maximize that as much as possible. And when they do that, most people don't realize that they don't get just one number that they get to pick from. Mm-hmm. They get multiple numbers.
Well, and that's where right off the rip, right? You're talking about which one do I pick and how many are there? Well, are you married? Are you single? Are you divorced? Is there a domestic orders relations on file at the pension system? These questions happen all the time.
Age difference.
Oh my God! You and
your spouse.
Oh, huge! How much older am I than my spouse? So I feel like the most important thing you said there was my vesting time. How long have I been in, and what system am I part of? Right? And because each system is different. Let's go one deeper, and I won't go any further. What tier am I? Oh boy, right? Like all of a sudden everyone's like looking at their pay stub like, wait a minute, what tier am I? 4, 3, 2, right? I feel like that's important to understand the difference within that.
And every state worker listening understands tier, but for people that don't have a pension, they don't maybe understand what that word tier is. Well, tier is basically when you were employed and what tier or what system your retirement falls into. Tier 1, 2, 3, 4, 5, I think 6 now, right?
Yeah, we got all the way to 6, and there probably will be a 7 soon.
And there'll be an 8 and a 9, and those tiers in reality are a way that the pension system can shore up their payments, because the original Tier 1, which actually my father was a Tier 1, they didn't pay anything into the system.
Right.
So they put no money into the system. It was based off of their years of service and their final pay, but yet they're getting a income stream for the rest of their life. Yeah. So, think about longevity and how long people are living. That could go on for a long period of time. So what do they need to do? They need to shore up that pension. So they keep coming out with different tiers, which, kind of change how long and how much people put into the pension system to kind of support prior retirees into the system.
Yeah.
And when they go into that system and they get their choices, they're going to have a list of choices. Usually it's on page 3 of their pension statement. Could be page 4, depending on the actual tier that they're in. But the first one, and the very first one on top there, is the single life option. You want to talk a little bit about that?
Sure. Yeah. I mean, so basically, and I'll just kind of zoom it out for people that, are starting to hear these words for the first time. What's going to happen is about a year before you retire, you get your packet every year, right? And whether it's from NYSET or from the LRS, and in the middle of that packet, what you just talked about, Mark, is all those different choices. And usually they only outline 3 when you get your packet, or 4. They don't usually give you the whole bevy of them, right? But then about a year from retirement, you get the whole bevy. You get the whole 14 choices. And that's when your brain should start saying, all right, we need to talk to a person that can help us make sure that we're doing the right thing. Because more often than not, the phone calls I get, and Matt Byers can confirm this, someone is calling me a week before their choice is due. And they're like, what do I do? Or they're calling me the day of. Like, hey, I'm going down to make my choice. Which one should I pick? And they haven't met with us yet. I'm like, oh my God, man, wait, you need time.
Or worst cases, they made the choice and they call you and it was the wrong choice on their financial situation.
Let's go through a real world. Let's go through a scenario. And nothing that no exposure of identity here, but I had a couple people I met with. He picked the pop-up quarter. And the pop-up means that his wife potentially would have outlived, he would have outlived his wife, right? Because if his wife passes, then the income pops back up to what it would have been if he took the single life option. If you look at genealogically, the wife and the husband, the wife's grandmother is still alive at 106 years old. The mom is 91 or 90, and she's in her 60s. And the husband is, historically, his grandfather passed away at 68. His father passed away at 69. He was 64 when we met. So I explained to them the choice they made, and all of a sudden the light bulb went on. And they were like, uh-oh, what do we have to do? So now we're pension option planning when the person's in their 60s. Oh, boy.
And to your point, to your point, the perfect example of that is your decision can't be based off of your coworkers or another person's decision. It has to be based off of your own individual financial situation.
I'll say this again. The water cooler talk is the #1 killer of a great financial plan. Oh, well, my guy said that term is better than a whole life, right? My guy said that this is better than that, right? Or just someone telling you what to do at the water cooler. Please use a financial professional. Make sure the plan is right for you. Sorry, didn't mean to sidebar you there.
Yeah, so the first option, single life, and basically what that means is that if you pick that choice, and let's say you died 1 week after retirement,
right? That's
it. Your pension stops because it's based off of your single life and only your life.
Yep.
So nothing continues for your spouse.
Nothing.
So I know, hey, if I'm married and I pick that choice, I'm going to have a little difficulty getting in the door at night when I go home to tell my spouse that they don't have any support behind me.
Hopefully there's another layer there and they have good news that they've worked with a professional. But to your point, there is a little bit of a caveat there, is that usually in the first year of retirement, if you take the single life, there's a benefit still that lingers from your former employer, whether it be the state or TRS. There's something that's there. Sometimes it's as good, it may not be as good, and most of it's not tax-free, and it's not the full pension. So yeah, that's a good point though. Yeah.
But after you get past that single life choice, to pick any other choice on that chart, it's going to cost you money.
Oh, absolutely. Lots of dollars.
And it can vary between 10%, 15, 20%.
Let's do a simple schematic, right? Like if I made $100,000 in my last 3 years of work, and I make 60%, because I made it 30 years in the teaching system, right? Well, what's my single life option going to be?
Well, let's say $50,000.
Right? Well, if I made it 30 years, I retire at 60%, and I made $100,000.
Oh yeah, $60,000.
$60,000, right? But if I take the spousal, I'm only going to make 52. Why? Why does that happen?
Yeah.
Help me.
Yeah, well, it's going to happen because now the state has to bet on both lives.
Oh, okay.
And, traditionally, females live longer than males and their life expectancy is longer. So you combine that with the fact that maybe your spouse is 3 or 4 years younger. Now the state has to plan on that pension payment continuing for maybe another 6 to 8 years.
Right.
So they're going to adjust the amount down to make sure that actuarially they have the same amount of money being paid out for most people.
And this is where people lose grip, is that, okay, I've worked for 30 years. I should be getting 60%. But the fear, we talked about this last time, right? Fear is driving my decision The fear of not having a different plan or having something alternate from the state pension system, right? The fear of taking that other look drives me to what decision? I take the spousal.
Yep.
And then what happens when I take the spousal? I get paid less.
For every year.
Forever.
For the rest of your life.
And then what happens if my spouse predeceases me?
You still get paid less.
Oh,
for the rest of your life.
This is important, right? So let's say I make 60 versus 55, right? For the spousal, the 100% spousal. And 2 years in, my wife passes away. So for the next 30 years, if I live, I'm making $5,000 less a year.
Because of the option that you picked.
Got it. Okay.
And that's why the pop-ups are there. Because heaven forbid your spouse predeceases you,
right.
It pops back up.
Okay.
To your original amount.
Got it.
But the question I always pose anybody that I meet with to talk about pension option planning is where does that $5,000 or $6,000 go? Or $8,000 or $10,000? Where does it go? If we actually put some thought into that, it goes back to New York State. So what are you doing? You're paying New York State $5,000, $6,000, $8,000, whatever it is, per year.
To guarantee what?
To an income to your spouse. So basically you're paying the state to protect your spouse. Well, I don't know. If a payment's leaving my house for $5,000, $10,000, whatever that is, I want to know where it's going, and I want to know, do I really need to pay it?
Right.
And part of pension option planning is looking at that dollar difference and taking that money and perhaps doing something different with it, such as maybe buying life insurance.
Good idea.
Where a lump sum check goes to my spouse when I die.
Yeah.
In most cases, tax-free. That can then generate what? A pension for my spouse. Yep. And in doing that planning, it might not take the full $6,000 or $7,000.
Yep.
It might only take $4,500.
I'm going to take 3, but depending on my health, which is why, again, the caveat here is how old are you? What's your health? What's the income stream? Everybody's different.
Yeah, it's not perfect for everybody, but that's why the math behind it is very important. And that's one of the things we're going to cover today is some of the math behind it.
Right.
But the math is something that needs to be done specifically in your situation. That's
Each
why
person,
you need
right.
an advisor to sit down with you,
Yep.
walk you through how they came up with the numbers and what it means to you or your spouse. Heaven forbid, a bunch of different scenarios happen. You die first, your spouse dies first, both of you live to life expectancy.
So like, I mean, even to ask your question, you started at the first question, which is where does the money go? I go a step further. I go a step before that. Who do you want to control your pension? Right? And I always ask that question because I know for myself, because I'm going to have one, who wants to control my pension? I want to control it, right? But then I go, before I ask where the money goes, Mark, you know what I ask them? I say, do you want to control your pension, right? What would you say?
Sure.
Of course. The next question I ask, would you want your pension to get to your kids? That's usually the one that makes people wake up and snap out of it. Because most times, especially in the teacher households or the police officer households, both people are going to have pensions. So imagine the differential, which is the difference between your single and your spousal, being $5,000 times 2. Because
that's a big decision.
Each person's doing it. So that's 10, 15 grand a year you're just giving away, which could potentially go somewhere else and do something potentially better.
Yeah, and the nice thing about looking at the math and looking at alternative vehicles to help maximize the pension is that those vehicles can give you benefits while you're living.
You just made me think of something. You made me think of something so funny. You ready? I did this analogy, and sometimes people hear the word life insurance or they hear the word annuity, and they just immediately shut down, all right? So let's do a fun game. So I'm going to describe something, but I'm not going to use the word, but I'm going to use other describers. You ready? Sure. So Mark, if I told you you could take your money, make it so that something is like guaranteed and it's tax-free and it lasts forever, potentially, would you use your money to do that?
Most likely.
Okay, that's called life insurance, right? And when you put the name on like a vague something like life insurance annuity, when you say that word first, right, it scares people sometimes. Again, fear. But let's do a different one. Ready? If you could take money and give it to someone and make a guaranteed income stream forever, would you do that?
Yeah.
It's called an annuity, right? Oh my God, right? So you have this light bulb moment where people don't know what potentially a word means, but then if you zoom out or you ask questions around it and then, oh, okay, cool. I was fearful. I didn't know what it was. Sorry, I didn't mean to cut you off there, but it was important.
Yeah, no, exactly. So, so let's just run with that concept a little bit. So, so our pension difference is, say, $6,000.
Perfect. Usually that's the number. It's around 6.
Yeah. And we go in and we say, all right, well, how much death benefit is needed to make sure that when the spouse dies, we can take that death benefit and then put it into vehicles that provide an income for them.
Got it.
A fixed income. And what we're trying to do is we're trying to have that pot of money be enough that it can supply the pension for life expectancy or beyond. And that pot is designed to zero out when that person, the second spouse, dies.
Right.
But the benefit is that each year that both spouses are still alive and continue on, the pot of money theoretically hasn't been depleted.
Right.
So that pot of money, if both spouses live to normal life expectancy, is still there then to go to kids, grandkids in a trust or any other type of planning.
Well, I feel like so that begs a question, right? When you work with a good advisor, you should be planning linear, right? A great advisor works with grandparents, parents, then kids. Because if we do a great job and money starts to go down efficiently, guess what? We're going to be managing dollars that are old and have grown.
Exactly.
Right?
Yep.
Doesn't that make sense?
Yeah. But once we understand pension option planning, the most important thing that we're doing is making sure that we have the right vehicles that we're putting the money into.
Right.
And, a lot of advisors will try to do pension option planning, but they'll use the wrong insurance policy for that person. Or they don't use a combination in some cases of term and whole life.
You hit that on the head. Let's dial back 1 sec. You ready? So imagine if I take my pension and I take the spousal and I'm giving away that $5,000 a year. Well, what if I need to borrow money from the pension system? Can I borrow money from them?
Nope, you can't call the pension system.
Oh man, but I'm giving them $5,000 a year. I can't call them and say, hey, I need a loan?
Nope.
But
they'll look at you and be like,
What are you talking about? But what if I did like a variable or a whole life type policy where I'm giving that $5,000 a year? Can I borrow from that?
Yeah, if you have built up cash value over a period of time, you can access cash value in that policy.
Okay.
The other nice thing is that if you do this planning correctly and you use the right vehicles, you can also incorporate some end of care planning, long-term care planning, because most life insurance policies, people don't realize, they've come a long way in the last 10 years or so. They've got riders on them that provide long-term care benefits, that provide access to the death benefit early, whether it's for chronic care, terminal illness, or other things like that. So that recycling of that money into your portfolio, right, because insurance is just part of a portfolio, can provide other living benefits and kind of kill two birds with one stone. So a lot of times our pension option planning conversations with the client are centered around not just the pension, but also making sure we're tackling end-of-life care, that we're tackling all those issues.
It's just what I like to call it a jack of all trades. It's your utility knife. And sometimes I think an analogy is great for people because the hammer might be the dollars that flow from pension benefit. The screwdriver might be the dollars that flow from Social Security. Well, when you don't need a hammer and you don't need a screwdriver, but you need a knife, what are you going to use? You can't use a hammer or a screwdriver. You need a knife. And I feel like sometimes for those people that work with their hands well, not me, I suck working with my hands, just FYI. I'd rather work with numbers and make jokes and have fun with people. But the truth is, if I need a knife, I need a knife. I can't use the other two tools.
Yeah, you can't just try to make things work. They have to work. Because you're dealing with a pension. And it's the most important part of somebody's life. So you want to make sure that the math behind it is accurate.
Got it.
And the product is accurate. So before we get into the products and the math a little bit, here's one of my favorite times. It's, that time, it's community spotlight time, baby.
Oh, the community spotlight.
Excellent. Where we like to always spend a part of our segment really just highlighting a business in the area that's doing some good in the area and can make clients aware that they're out there and hopefully they can use some of their services well. And today we have a great one. I'll let you cover this one today.
Yeah, it was actually, it's one of my first businesses I ever started working with and they're fantastic. My daughter went there as a kid, Little Ones Daycare. They have a Little Ones Montessori school as well. Jade is fantastic. Her staff is fantastic. They have great people, tremendous in the community. They do a lot of give backs. We like to try to send them a pizza once a year. I know sometimes we time it up when they're already getting pizza, but it's just kind of how we show the love. But yeah, they're over on 1184 Rugby Road in Schenectady. Their phone number is 518-898-0994. Fantastic place to send your kids. My daughter went there as a very young little girl, and now she's almost in second grade, which is Dude, it's flying. I cannot believe how big she's getting. But yeah, I mean, she went there for her youth, and she loved it, and we got a great experience. And I just wanted to make sure they know that we love them, and I'm happy that we send them some people. Hopefully, they get some business from it.
Nice. Little one's daycare, so not for you.
Not for me. Not for me. More like big guys daycare, right? My wife would love to drop me off at a place like that, I bet.
Great. So, let's get into math a little bit and just understanding. So, common mistake is people think that they need to replace 30 years of pension. They need 30 times their annual salary, right? But they forget that when insurance pays out, it pays out as a lump sum.
Right.
And that lump sum, then you have options on how you invest it. What rate of return it can get, what it can go into, the different types of vehicles that it can go into.
You said lump sum, right? So if you look at your TRS or your LRS statement, it'll actually have a lump sum option. What a lot of people don't know is that is not federally tax-free. That is all taxable. So that would all have to go into like an IRA, or it would have to all be taxed. So let's say your federal, or let's say your lump sum option is $900,000, right? Well, you're going to lose 44% of that right off the rip.
Yeah, but in pension option planning, right? They don't need 30 times that annual
not
payment.
at all.
There's actually some factor tables and guides that we can use that tell them that, hey, you know what? If you need 30 years of pension, that might only be 18 or 19 times your actual annual salary.
Correct.
And then not only that, but we also have to consider that the life insurance death benefit is income tax free.
100% tax free.
Big difference than what you're describing from the pension lump sum.
Yeah, I mean, because you'll see it on your pension statement. It'll say lump sum, and a lot of people don't know that is not federally tax-free, whereas life insurance is tax-free at the state and the federal level.
Yeah, so from the math standpoint, it's not a direct year per year times the amount that you need.
So let's go back to the example.
The other thing to keep in consideration is if you're picking a joint option and the spouse is getting $50,000, say,
right?
Their after-tax portion only means they're getting 40.
Right, because they got to pay the Fed and the state.
Right, so you can also consider structuring the investments in a way where they're not paying the income tax portion on those benefits.
Right.
And they need maybe less than what they think because that taxable equivalent is the same.
Do the real world double whammy, okay? You got two people who have worked 30 years in a pension system, and they both pick the spousal option. In my mind, for when I see people, that is literally the ultimate double whammy. You're both paying into the system after the fact, right? And then if you both die relatively close together, all the money you spent was for nothing.
It's like going to roulette and betting on green.
Right.
There's only one green spot.
You're going to go all green, right? But the truth is that's like the ultimate double whammy is if my wife and I both take the spousal and then we both die within a month of each other right away. That would be brutal because all the time you put into the system is now gone. You can't get it back.
Yeah, exactly.
Right? Whereas sometimes, and again, you could work the math on the scenario, one spouse may not be as healthy as the other. So one spouse might have to take the spousal, and one spouse might be in super good health, and they might take the max option with life insurance behind it.
Yeah, and the great thing about those 14 different choices is it doesn't have to be a joint 100% option versus a single life. You can build in an option plan that has 25% of the pension going to your spouse and the remainder going through life insurance. So you can really customize the numbers around somebody's pension difference and their situation, which is what we like doing because we want to make sure that maybe we can get the person more money while they're living because we can do the pension planning for less than what the state is charging.
Say that better. Do it sooner.
Correct.
Don't wait until you're 55 because then you haven't had any time to build this and make it grow, right?
Well, to your point, let's delve down on that a little bit. What's the most dangerous time? It's the year or two before somebody retires. And why is that?
Well, most of the time you're under a lot more stress. Your health you're older, so your health potentially is trending downward, and you're focusing on the end of your career.
And I'm thinking you haven't triggered your pension. So if you pass
real double whammy, right?
Yeah, if you pass before you're retired, your spouse isn't getting your pension.
They only get 3 times your annual benefit.
They're getting your group term life insurance benefit.
Well,
3 times.
So there's a benefit through every LRS, which is 3 times the annual salary, and 50,000 is tax free. The rest of it's not. Goes to a Benning IRA. But then if they have group term, then they could activate it. Let's do a real world. Ready? Before I retire, I do a pension option plan, right? People are like, wait a minute, why would I do that? Stay with me. You're 52. You did a pension option plan. Maybe it costs you $4,000 a year. By the time you turn 55, you're sick. Something's wrong. So the pension option plan now has changed. Now, instead of picking the max option, knowing I'm sick, what am I going to take? Max spousal. I'm going to take the spousal 100. And if I die, my wife gets a life insurance and my spousal payment. That's why you want to do it before you get to your pension, before you go, you know?
And some of the best times to do it is when you're actually a new employee.
Absolutely.
You know, when you're in your 30s, when you're in your 30s,
yeah.
you can do a lot of this planning
Absolutely.
in limited pay policies,
Yep.
where you're only paying on them for a certain
Period
number
of
of
time.
years. So
Yep.
you're done paying before you even retire.
And you have to incorporate other stuff too, but yeah.
And you're healthier, and you get more life insurance death benefit for the buck because of your age. So, you know, there's a lot to be said to starting some of that planning early, but people usually don't think that far ahead.
That's the water cooler talk right there. We're right back to where we started, the fear and the water cooler talk. Oh, my advisor or okay, so let's, again, zoom out, right? My advisor, someone that potentially is a fiduciary, is saying, this is why I should do this. Whereas an agent is not a fiduciary. Critical understanding, right? That's like, I feel like we need to add that. Critical understanding. What's an agent? Does an agent have an obligation of care?
No.
Does a rep have an obligation of care?
Yeah.
Okay. Does an advisor or fiduciary have an obligation of care?
Yeah.
When people are buying this stuff, you should be asking the person you're working with, do you have an obligation of care? Why are you talking to me about this? Then the second piece is what? What lineup of stuff are you using? Because at Cetera, we can use whatever we want as long as Cetera approves it. That means it's got to be a very highly rated company. So do we really have a dog in the race? Do we care who we use? They got to be the best.
Well, we want to make sure that the decision, right, is always in the client's best interest.
Of course.
And
Absolutely.
that's why we started with, you know, pension option planning doesn't work for everybody.
It doesn't.
But you know what? I would say for
Vast majority.
For most people, it's worth considering. It's worth looking at and exploring that. So
It's not perfect. It's not perfect.
yeah, let's recap. You know, maybe some living benefits. You know, we've discussed pension option planning in the sense of why and what we're doing with it and stuff like that. But you know, think about the fact that you're recycling that money that would have went to New York State.
Sure.
And now you have some living benefits. One, in a lot of cases, whole life insurance is considered a non-correlated assets, meaning it doesn't fluctuate the same as, say, a portfolio that's invested in the market.
Okay.
So why is that important? Well, let's say the stock market goes down during a period of time in your retirement, and you want to stop drawing from some of your IRAs and your 401k money or deferred comp or whatever.
Right.
You can do that if you have a non-correlated asset, one that perhaps doesn't have any fluctuation due to the stock market or things along that line. So that ability to access non-correlated dollars can help you with your retirement planning on the other asset.
That goes back to the can I borrow from the pension system question, right? Because if I'm giving money to the pension system in retirement, I can't call and say, hey, I need $5,000. But if you have a policy that's a whole life, that's grown cash, 20 years in, the market's doing what it's doing right now. Oh boy, I want to go on that vacation. I want to go buy that beach house. I want to go buy that car. Should I be taking money out when the market's down?
Correct.
In
And
some
as
cases,
we
no.
had said, one of the other living benefits
Right.
is the ability to add on long-term care riders to certain policies so that we can access the death benefit dollars should we need at the end of life or care.
Yep.
Right? So those are just some major benefits while you're living.
Yeah.
Right, and then you combine that with the snowball effect, which I call, which is basically both you and your spouse live till normal life expectancy, and
Both
most
85.
You know, in most marriages, you see a spouse dies, the other spouse dies a
Relatively
year or two
soon,
later.
yeah.
You know,
You can't live without them, Mark.
you know, broken heart, you know,
Yeah.
or whatever it might be. But that's a best case scenario for pension option planning because all of that death benefit that would have went to the spouse to shore up the pension now goes to the kids or grandkids. Whereas in the New York State plan, what happens? You're paying New York State.
Right.
New York State keeps it.
It's just a kind of, again, that double whammy situation where you're giving away those dollars and you could be doing other things with them. But in addition, I'm going to go one further on the benefit access rider and the end of life care. When you're in your 70s and you're not earning income, can you do a Roth IRA?
No.
Can you do...
Well, technically through conversion. But
you could do it through conversion.
That's another episode.
That's another episode, but I want to ask this question for a good reason. You're in your 70s. Can you do, if you're not earned income, can you contribute to a Roth IRA?
No.
Can you contribute to a traditional IRA?
No.
If you don't have a job, can you do a 403B or 401k?
No.
So you have all this income from pension and Social Security and investments. Well, when I have all this income, where does all that money end up?
ends up in a savings account in most cases.
Oh,
for
in a
clients.
bank, right? And what are the interest rates at banks right now?
Yeah, very low.
So my dollars are sitting in a bank. Okay, so Matt, if I go invest these dollars in the stock market, what am I going to have to take on? Risk. And if the market does explode and go up, now all the money that I've made is what? Taxable. So,
and if you keep your money in the bank, you have risk of inflation risk.
Right. So this year, right, 7% inflation. So my $100,000 is now worth what? Yeah, 93. Damn, I just lost $7,000. I didn't even do anything. But if I put my money in the market, maybe the 100,000 is only worth 83 because I have to take risk to grow the asset. Wait a minute. If I have a pension option plan that has a potential to flex or do more into the plan, and the market does go up, I could take money from my investments or from Social Security and do what with it? I could dump it into the plan. Yeah. Thus, driving up my cash value, driving up my death benefit, getting more access, right? Like this domino effect happens and it's real. And I'm just going to ask people that are listening, do not be fearful to go down this rabbit hole because there are a lot of parishioners out there of, buy term, invest the rest and group term life insurance. And yeah, you know what? And is where I will go toe to toe with some of those parishioners. Those people have millions of dollars and you don't. And they can lean back on their billion-dollar mansions and go into their yachts and you cannot, right? And that's where I would love to go toe-to-toe with one of those white-collar guys.
Yes. Obviously, this is a very complicated topic to explain on the air, but we don't shy away from issues that are complicated.
Nope.
We want to make sure that people understand that there's opportunity out there, and the more options you have in retirement, the better. So I think we did a great job of painting the picture of pension option planning.
I hope we did.
I would encourage everybody, if they have questions, direct them over to us, and we can sit down and analyze their specific situation and just be open and honest with them and let them know whether it actually makes sense for them to consider it or not, which is the main thing.
I agree 100%. Hopefully this stimulates, it gets those people mentally doing those mental gymnastics. And, it looks like we're out of time, but, I always want to finish up our show with our recap, right, and our hot buttons. So where did you want to start? Do you want to start with our minute by minute?
Yeah. So let's start with the recap.
Okay.
Right?
Cool.
So for the state worker / pensioner, we want to make sure that they're looking at all their options and that they understand their options. So the first thing they're going to want to do is they're going to want to contact their retirement department and get their options.
Yeah. Get your pension numbers.
Get your pension numbers.
Yep.
You also want to have a clear understanding of your tier and what percentage per year you get and where you can maximize that, okay? Because if you're a year or two from retirement and let's say you're at 19 years of service, it's important to know that at 20 your pension amount can jump quite substantially. The other thing that you're going to want to do is you're going to want to make sure you sit down with an advisor. You're going to want to sit down with a professional. You're going to want to have that conversation with all your assets and your pension and say, is it worth it for me to do this? And can I be looking at some different options besides just the pension choices?
Well, have a conversation, right? Don't be afraid to have a conversation. And again, when you have the conversation, don't vet it with people that don't know or aren't licensed, right? Vet it with another professional and go to another professional and double check, hey, are you a fiduciary?
Correct.
Right? Right? You know what I'm saying? That's a good way as a consumer. That's a good way to really test a theory.
Yep.
Right?
And the final point in the recap is to make sure you always have your spouse involved in that decision.
Oh my goodness, absolutely.
By having your spouse involved in the decision, you both go into it knowing fair and balanced what that option is going to generate for the family and the household.
There's been times when I meet with people and they don't have their spouse and I'm like, okay, so we're not going to meet today. And get your spouse here because it's going to be way easier because if you try to tell your spouse what I said to you, about 5 minutes in, she's going to want to kill you or he's going to want to kill you. So just you keep it simple. Have your spouse there. You're right. Yeah. Absolutely, Mark.
Excellent. So great episode. I think we covered a lot of good topics. Let's get into minute by minute a little bit and, just break the wall down on kind of some of the personal stuff that we have going on and stuff like that. So I just went on vacation. I told you about that. I went to Myrtle Beach with my family. Loved it. You got any favorite vacation spots?
What's a vacation? What's a vacation? I don't understand what that word means, Mark. What does that word mean?
Well, you get it in the summer sometime.
Oh, the summer. Yeah. When I sit by my pool for about 30 seconds before I'm back on the phone. Yeah. Vacation. You're funny. Okay, good. Good talking on that one. Now, where'd you guys go? Where was it?
Myrtle Beach.
Oh, that's
It was
great.
our first time there, so it was actually very nice.
Did it have like a nice boardwalk?
So-
Like, is it like vendors?
No, where
and-
we were, it wasn't really a boardwalk, but the hotel we stayed at had some slides and indoor pools for the kids and stuff like that.
I feel like the kid-friendly vacations are going to be the spots where people want to hit. Like just getting out and getting your kids active.
Unless you're retired, and then you want to maybe stay away
Then
from
you
the
want to be in Florida hanging out with the people your own age, right? But kid-friendly vacations, I think a lot of parents out there are kind of stir crazy, and they want to go on vacation and have fun, but they also want their kids to get the heck out of their hair and be safe, right? I feel like that's a pretty common thing right now.
Yeah, excellent. You got any hobbies?
Yeah, man. I'm tell you what, I love Marvel movies. The Multiverse of Madness is coming out, and I'm excited for Doctor Strange. I'm excited for all the great shows coming up on Disney Plus. I don't know if we're supposed to say that or not, but maybe we have to cut it if we have to. I'm sorry, but there's some really cool Marvel movies coming out, and I'm really excited to see them. Obviously, big fan of Thor, and love his movies. Love and Thunder's coming out. Big fan of their director. There's some great shows I've been watching lately, actually. What the heck's the name of it? It wasn't The Wheel of Time. It was, The Mayor of Kingstown. That's kind of violent, but it was a really good show. I really liked it. Christine and I watched it, so it was fun.
Excellent. Awesome, man. Well, it was great chatting with you today.
Absolutely.
Let's close out with just a little information on how people can get hold of us. We're at 43 British American Boulevard, first floor in Latham, New York, 12110. You can reach us at 800-222-3202. And as always, important, yourtimeyourmoney.net. And it's .net for your net worth. So feel free to go to that link. It'll direct you to our podcast page, our team page, our homepage, so you can get additional information and stuff that we do for
We must have a genius for a marketing guy. He must be a bald guy for sure.
Well,
All right,
thanks
man.
a lot. Have a great day, man. Thanks.
All right.
Take care.
Enjoyed it. Your time, your money.
Your time, your money.